You ever listen to people talk about finance and feel like they're speaking a totally different language? Yeah, you are not alone. But don't worry, in the next few minutes, think of us as your personal translator. We're going to simplify the stock market one term at a time. And this quote right here, it absolutely nails it. It only sounds hard because of the words. Seriously, the vocabulary is the biggest wall for most people. But once you get the language down, you'll see the ideas behind it all are actually way more straightforward than you'd think. So that's our promise to you today. We are going to strip away all that confusing jargon and just give you the simple, essential building blocks. By the end of this, you'll have a much clearer picture of what's really going on in the market. All right, let's dive in. Section 1, what is the market? We're starting with the absolute basics here. I mean, the most fundamental piece of the whole puzzle. What even is a stock? It's really as simple as this. Imagine a company is a giant 1,000-piece puzzle. When you buy a stock, you're basically just buying one single piece of that puzzle. You're a part owner. And if that company does well and the whole picture becomes more valuable, guess what? Your little piece does too. Okay, so you'll hear people use the words stock and share like they're the same thing. And they kind of are, but there's a tiny difference. You own stock in a company. That's the concept of your ownership. But a share is the actual unit you buy. Like the slide says, if the stock is the whole pizza, a share is one slice. The more shares you buy, the more slices of that pizza you own. So where does all this happen? Well, that's the stock market. Think of it as a gigantic digital marketplace. It's not some building on Wall Street you have to go to anymore. It's a massive global network where all those shares, all those little pieces of companies, are bought and sold, literally every second of the day. But wait, how do companies get onto this marketplace to begin with? Well, that happens through something called an IPO, or initial public offering. You can think of it like a company's big debut. They're going from being privately owned to going public, opening their doors and selling shares to people like you and me for the very first time. So, who are all these people buying and selling on this big digital marketplace? It's filled with millions of people, all with different goals and strategies. Let's talk about who they are. Which brings us to Section 2, the people and tools. Let's break down who's actually in the game and what they're using. You know, when you boil it all down, there are really two main types of players, and they have completely different mindsets. First up, you've got the investor. These are the people playing the long game. They aren't stressed about what the market does today or tomorrow. They plan to seed their investment, and they're patient, waiting for it to grow into a big, strong tree over many years. And then you have the trader, pretty much the polar opposite. Traders live for the short-term action. They're jumping in and out of stocks, sometimes within minutes, trying to make a quick profit from tiny price moves. It's a totally different game, way more high speed and high stress. Okay, now whether you're a long-term investor or a fast-moving trader, this next idea is absolutely crucial. It's called diversification. You've heard the saying, don't put all your eggs in one basket, right? Well, that's literally it. You spread your money across different investments, so if one of them goes sour, you don't lose everything. So what's an easy way to do that? Enter the ETF, or Exchange Traded Fund. Think of it like buying a whole basket of stocks all at once. With just one click, one single purchase, you can instantly own tiny pieces of hundreds of different companies. It's diversification made simple. Okay, Section 3, the market's personality. Because when you get all these people buying and selling, the market starts to develop a personality. It has moods, it has swings, and these create powerful trends. When everyone's feeling optimistic, confident, and prices are generally going up, that's a bull market. The image is perfect, right? A bull charges and thrusts its horns up. And the opposite of that, you guessed it, a bear market. This is when things are heading down, people are getting fearful, and pessimism takes over. And again, the image is super easy to remember. A bear swipes its massive paws down. Now, the speed and intensity of these ups and downs, that's what we call volatility. A low volatility market is kind of like a calm lake, but high volatility, well, that's a wild roller coaster. The climbs are exciting for sure, but those drops can be stomach-turning. All right, Section 4, how we keep score. With all this up and down, this bull and bear action, how do we actually measure what's going on? Let's talk about the metrics. First up is market cap, which is short for market capitalization. All this is really is the total value of a company's shares put together. It's just a quick way to see how big a company is. You'll hear about large cap companies, those are the giants, and small cap companies, the smaller players. So that's one company, but what about the market as a whole? How's the whole team doing? Well, that's what an index is for. Think of something like the S&P 500. It's basically a scoreboard that tracks a big group of stocks to give us a quick snapshot of how a whole section of the market is performing.
You know, a stock's price going up isn't the only way to make money. Some companies, when they make a profit, will share a piece of it directly with their owners, the shareholders. That little payment is called a dividend. It's like a cash thank you just for being an owner.
Okay, our last section, what you get back. Because when it comes right down to it, every single thing we've talked about is governed by one fundamental, inescapable trade-off. And that is the relationship between risk and return. They are two sides of the very same coin. You can't have one without the other. Risk is pretty simple. It's the chance you might lose money. And return? That's what you make, or lose. And here's the #1 rule of the game. If you want the potential for a higher return, you almost always have to be willing to take on higher risk. And that's really the core of it. See? Not so scary once you translate the language, is it? The stock market isn't some big scary monster. It's just a system with its own language. And by listening to this, you've just learned the basics of that language. You've taken the biggest first step. So the real question is, now that you know the words, are you ready to learn the game?